Hey gang, this is Vinny Biscotto with the Biscotto team, and I'm here to talk to you today about an adjustable rate mortgage, an ARM versus a fixed rate mortgage, right? So right now, as rates are not exactly low where we would want them, right? The lower the better. It makes housing more affordable for us and makes our budget smile. So, of course, we want to find ways to lower those rates and lower our payment as we get into a new home. And one of the things that's happening right now is there are banks that are offering adjustable rate mortgages because it gives you a little bit of a break as you go into that loan as far as payment. Let's just say right now on an FHA loan that, you're at 6.5%. Well, maybe the ARM is going to be 5.875. And you might say to yourself, well, the difference in that is significant, and I'd like to take the lower payment and go with the adjustable rate mortgage. But there's a couple things that you need to think about. When you are an adjustable rate mortgage, what happens is that you during that period of time are in that fixed period. So if you're in a 5-year ARM, you're going to be set at that initial rate and your payment is going to be based upon that. Now, when that period of time is over and you come out, so if you're in a 5-year ARM and you come out to year 6, you're going to be open to the market and you're going to have an adjustment with a cap, but you're still going to adjust. So if the market's higher, you're going to go higher. If the market's lower, you're going to go lower. However, the difference between the adjustable rate mortgage, the ARM, and the fixed rate, what gets overlooked is that if you were to use an FHA loan and use a temporary buy down for the first 2 years, you're going to be lower than what the payment is on the adjustable rate mortgage. And you're not going to have to automatically refi when that period is over. So if you're in an FHA loan and you're using a temporary buy down, your payment's going to be based, if the market's at 7%, your payment's going to be based on 5%. And so when that period is over, you can do a streamlined refinance. Doesn't really cost much. It's really affordable, and it's so much cheaper than the cost of refinancing an ARM or the adjustable rate mortgage. So it may seem appealing when you see that lower rate. However, you can get a lower payment by using a temporary buy down and have cheaper costs to refinance by going that way instead of the ARM and having to do a conventional refinance. Night and day difference in cost. So I hope this helps. If you're out there and you're shopping rates and you're looking and you want to purchase a home, there's a way we can address your budget and we can deal with those payments that you do not have to use an adjustable rate mortgage. So if you'd like to learn more about this or you'd like to get started and get your approval, you can call me, Vinny, at 817-714-5090, or you can reach us at thebiscottoteam.com. And remember, for all your mortgage needs, talk to Vinny. Have a great day, everybody. Bye-bye.